Did you know that the government will force you to take your retirement funds out? This forced distribution is called a required minimum distribution, or an RMD. And if you don't take it, you could face penalties up to 25% of the amount that you didn't take out. If we haven't met yet, I'm Josh Leonard, President and Financial Advisor at the Leonard Advisory Group, where we help those nearing and in retirement to retire with intent. I host a regular podcast, Relax It's Retirement, as well as host monthly lunch webinars and do short videos like this. Our goal is to provide resources to help you thrive in retirement. Today we're going to be talking about RMDs. An RMD, or a required minimum distribution, is a specific amount that is the minimum amount you must be taking out of your qualified retirement accounts starting at a specific age, depending on when you were born. If you were born June 30th, 1949 or earlier, you would have had to already start taking those RMDs starting at age 70 and a half. If you were born July 1st, 1949 through the end of 1950, you would have had to start taking those distributions at age 72. If you were born January 1st, 1951 through December 31st, 1959, you would be taking your RMDs starting at age 73. For most folks looking at starting RMDs now, that would be the case for you. If you were born after that, you're not required to start taking distributions until age 75. Now, how do you figure out how much you need to take out of your qualified retirement accounts, and what is a qualified retirement account? A qualified retirement account is a tax-deferred account that you put pre-tax money in. So most commonly we think of an IRA or maybe a 401k. A traditional 401k is a plan that maybe you've saved throughout the years at your place of work. You've put money into that plan without paying taxes on it. That money has continued to grow without taxation, but now you are forced to distribute that starting, if you're nearing now, let's say age 73, you're required to take that money out. As you withdraw that money out in retirement, it is taxable, including with your RMDs. Other qualified retirement accounts could be things like 403Bs. So anything that you put the money in without paying taxes on it would be a qualified retirement account. How do we figure out what our RMD is? Well, the IRS publishes a table of factors based on age to tell you how much to take out. If you're nearing that RMD age, or maybe this is your first year that you're taking RMDs, you just turned age 73 this year, in your first year, that divisor or that factor is 26.5. So we take the year prior end balance of your qualified retirement account and divide it by that 26.5. For most folks, an easier way to think about it would be, what percentage rate do I need to withdraw? In that first year, that percentage rate is 3.77%. Now, each and every year, that factor goes up slightly, or the amount you need to take out as a percentage goes up slightly based on your age. So as you get older, the amount you need to take out grows. However, they are never forcing you to take 100% of the account out. For a lot of folks in retirement, the RMD is not a big concern. Maybe they're already taking out more than they're required to take out. Maybe they've purchased something like an annuity with an income rider that is helping to generate income for them in retirement, and maybe that guaranteed payment under an income rider exceeds the required amount that they need to take out. It doesn't mean that they need to then take additional funds out. If your regular withdrawals are already exceeding that minimum amount, it is not a worry. Now, in the second piece of this video, we're going to focus on 6 different ways to reduce RMDs. So if you're in the other camp, where you've been a great saver, and maybe you saved a little bit too much in those qualified accounts, where you're forced in the future to take out more than you need today, we're going to talk about 6 different ways to potentially reduce the required amount that you have to take out. The problem with being forced to take out more than you need is the taxation. You are taxed on those withdrawals. So we don't want to be paying unnecessary taxes ever. Reducing taxes in retirement is a great way to help mitigate risk for those folks in retirement. The first thing we can do to potentially lower our required minimum distributions and hopefully our overall taxation is focus on our asset location. Now, many times you'll hear your asset allocation. Are you 60% stocks, 40% bonds? Are you more aggressive? So maybe you have 80% of your portfolio in stocks and only 20% in bonds. That's your asset allocation. Your asset location is what type of account those assets are held in. So maybe you're comfortable taking a little bit more risk. So we want to have our risky assets typically in those accounts we're not going to use for a longer period of time. So if you're looking out to your RMDs and you're thinking, hey, I'm going to need to start taking that 3.77% Josh referenced in a couple years, I'm going to need to tap into a portion of this money. You may want to be more conservative with that. So many times we'll advise folks to be more aggressive in their Roth IRAs. If you have one, be more aggressive in those accounts that we're not forced to take distributions from, and be more conservative in our IRAs. If we're looking at a total portfolio allocation of 60-40, maybe we hold more of the stocks in our Roth IRA and more of the bonds or the more conservative pieces in our IRAs. What that'll do, while your money as a whole is still growing, which is something we always want to do, our more conservative assets are held in the fully taxable account, your IRA. Now, if your IRA is growing on average a little bit less than your Roth IRA, well, we're reducing our RMDs. So the first way that we can look to reduce our RMDs is by looking at our asset location, placing our more risky assets in more tax advantageous accounts, and being a little bit more conservative in our IRAs to hopefully still grow that balance enough to meet our needs, but to keep that in check a little bit more so that we're not forcing higher distributions that we may not need in the future. The second way to potentially reduce our RMDs is through a Roth conversion. Now, in our early years of retirement, prior to if you're retiring today, maybe age 73, maybe age 75, depending on when you're born. Prior to those RMDs, we may want to look at Roth conversions. So utilizing spending from things like savings or brokerage accounts, and then taking out some IRA or 401k money, paying taxes on it, moving it over to a Roth IRA. We can allow those funds to continue to grow and not worry about the future tax impact of those because we've paid the tax today. Now, typically, this is a strategic plan that we're laying out over years. We at the Leonard Advisory Group focus on keeping your taxation low over time. We are not going to have any wild assumptions that taxes are going to double overnight or anything like that. We're going to simply look at what tax rate, based on your current plan, you're going to be paying come that RMD age. If that's higher than the tax bracket you're in now, we're going to start strategically looking at doing Roth conversions. Now, what that enables you as an investor to do is take more risk on those IRA assets. Again, keep it conservative like we talked about in the first point, but have a lower distribution in the future, thus reducing your RMDs overall. Our third way to potentially reduce our RMDs is to delay taking Social Security. Delay Social Security, what does that have to do with our RMDs? Much like the Roth conversion we just talked about, if we're able to spend down other assets and defer Social Security, we have the opportunity to reduce the taxable amount of our IRAs. So maybe rather than doing a Roth conversion, maybe we take a portion of our IRA out a bit earlier to reduce that total balance. By spending that money, it's not in an IRA. It's not going to count towards our RMDs in the future. By doing that, we defer our Social Security, potentially out till age 70, and we have the ability to let that Social Security benefit grow. Now, when we are taking Social Security later on, if we need that money for income, rather than taking from an IRA, we're going to pay at a lower tax rate. Our Social Security payments, at most under current law, can be taxed at 85%. In other words, 85% of the amount of income we're receiving from Social Security would be pulled into our taxable income. If we are taking that same amount of money out of an IRA, 100% of it would be taxed as regular income. So we have the ability to play a tax game there by delaying our Social Security and potentially reducing our RMDs in the future. The fourth way we can reduce our required minimum distributions and the taxation on it is through qualified charitable distributions, also known as QCDs. A qualified charitable distribution allows you, starting at age 70 and a half, to take money from an IRA and give it to charity without paying any taxes on it. Now, a lot of folks that we meet with, maybe they're regularly giving to local charities or their church, and they write a check out to those charities or give them cash maybe in a collections basket or something like that. Now, in order to deduct that off of your tax returns, you must itemize. With the higher standard deduction, since the Trump tax cuts, many folks are not itemizing, so they're not even tracking those charitable deductions anymore. Instead of doing it that way, after age 70 and a half, you can take the money from your IRA and send it over directly to the charity. By doing that, it's not counted as taxable income at all. Now, we have to keep in mind there is a limit to the amount we can give to charity via a QCD. That limit for 2024 is $105,000. That represents a $5,000 increase from the year prior. While that is set to an increase over time, we want to make sure we keep that limit in mind. A QCD and giving through a QCD is going to help reduce the balance in our IRA, our qualified retirement account, thus reducing our future RMDs. Even after age 73, if you're not taking an RMD yet, or age 75, again, if you're not taking that RMD yet, we can continue to use QCDs. So part of the distribution we're required to take, or all of it, we can give to charity, thus not pushing ourselves up a tax bracket. For many folks, it makes sense to start utilizing the QCD as soon as they turn age 70 and a half to help levelize the amount that you have to take out over time. We're not required to take that distribution yet. If you're just looking at QCDs in the future, or if you just turned 70 and a half, let's start taking advantage of that strategy now. The fifth way we can potentially reduce our RMDs is to use charity giving tools like a donor-advised fund. A donor-advised fund can be like a retirement charity account. We can make a one-time lump sum deposit into the account and take the tax deduction that year and then slowly distribute those funds out to the charities we desire over time. The donor-advised fund acts as the charity. We gift the money to charity via a donor-advised fund. That donor-advised fund, we can invest the money and then choose to disperse that money over time. That fund can even be inherited by the next generation. We can't, however, take the money back out of the QCD at any time. By giving the money to the QCD, we are committing that money to charity, and that's an irreversible decision. Now, many folks might utilize a QCD in a particularly high tax year, or we might pair it with something like a Roth conversion. If we're trying to be very aggressive with a Roth conversion to help reduce those RMDs in the future, we can utilize the donor-advised fund to reduce our taxes overall, to make that a little bit more palatable. If we are exceeding the QCD amounts, if we want to give to charity more than $105,000 a year from our IRA, well, we might want to use something like a donor-advised fund there as well to do that big lump sum at once. Now, the major advantage of the QCD is that we can take the tax deduction in 1 year, but disperse the money to the charities we care for more slowly over time. It becomes a very easy way to track your charitable giving over time. The sixth way is to factor in your legacy. Now, if you inherit an IRA from a parent, you most likely will need to distribute those assets over a 10-year time period. So if you inherit $1 million IRA, you would need to take out $100,000 a year in order to get all the money out, assuming no interest over that 10-year time period. If you think about your kids or your beneficiaries, are they going to be in a higher tax bracket Later on in life, when you could be potentially adding $100,000 or more, or let's say your IRA balance is even larger than that. What if you had a $5 million IRA? You're almost by default going to bump them into the highest possible tax bracket. One way to look at reducing your RMDs is to look at the next generation. Does it make sense to start taking more of that money out early in retirement in order to reduce that potential tax impact for the next generation? By doing that early in retirement, we also get the fringe benefit of reducing those RMDs in the future. So the sixth way is to think about the next generation. What's the tax impact for them? At the end of the day, for most folks we work with, the end goal is to keep the most money in the family, not pay the most in taxes. So think about the next generation. We help clients all the time do some hypothetical situations around tax brackets for their kids and what that might look like when they inherit funds later on in life. I hope this video helped educate you about RMDs and give you some strategies to potentially have more control over your RMDs and ultimately reduce taxation or reach your goals in a more efficient manner. If you're not already working with a financial advisor or having these more detailed discussions around your RMDs and long-term planning, we'd be happy to help. At the Leonard Advisory Group, our focus is on helping those nearing and in retirement retire with intent and thrive throughout retirement. To learn more about us, check out our website at leonardadvisorygroup.com, where you can schedule a 15-minute call with myself or one of our other advisors to see if we might be a good fit to help you reach your retirement goals. Thanks for watching. Make sure to subscribe, like, and share our videos with others in similar situations. This helps us continue to provide this great content for you.